Good afternoon, everyone. Well, a lot of you are here already. If you see that that the display is blurry, just reload the page and it'll sharpen it up. I couldn't fix that, but that's basically the software that I'm using, the noise from the software I'm using. And I tried to upgrade to using a new iPad, and I'm gonna also need a new computer. This is how it goes. So I'm just going to wait for people to come in. Hi, everybody who's here. And when I pause the microphone, I'm sure the static is gone. I was trying to use my AirPods, but they didn't help with the static, and they have no pause or mute button, so that wouldn't be good. It's always a trade-off. Hi, Nicole, Kevin, Jean, Chloe, Mario. So what I'm going to do is work through or just review the chapters. The first test is not until the first, the end of the month or the first weekend of October. And I'll give you a few days to work on it. It'll be in Connect. And you can use all your materials. The chapters I want to include are 1 through 6, but if we just get through 1 through 5, then so be it. But for now, it's 1 through 6. So I just wanted to highlight some of the points in the chapters. Also give you supplementary tools. If you read through the entire book and the technical portions of the chapters, you're going to get into the techniques of optimization using calculus. And although you can do this course without calculus, I think it adds to comprehension. It does for me anyways. Hello. So I'll repeat what I said at the beginning, at the end, and then in case people missed it or came in late. So this is a course in managerial economics. We're going to look at you've already started, looking at the larger economic and market forces that contribute to the day-to-day business practices. And as well, we look at strategies for sustaining the long-run profitability of the firm. So we're looking at profit maximization in the short and long term. The idea is to develop a systematic, logical approach to understanding business decisions and strategies for now and for the long run, right? Future. So We want to figure out, we want to remain focused. The objective of the firm is to, or the goal of the firm is profit maximization and protecting those profits in the long run. That's a really important point, and I'm going to address it in a little bit more. Okay, so I'm just going to go back to the learning objectives to make sure we've covered them in our discussion. So you want to understand why managerial economics relies on microeconomics and industrial organization to analyze business practices and to design business strategies. So what is microeconomics? Microeconomics is that branch of economics that focuses on the behavior of individual segments of the economy. So that's consumers, employees, owners of resources, owners of firms, or firms themselves, and the markets for goods and services, including inputs to production. The toolkit of microeconomics is optimization. Optimization. We want to optimize. Profit maximization is our goal. And sometimes that involves cost minimization. Both are optimization issues of questions of optimization. Economic theory helps managers understand real-world business problems. And to do that, we use models. And the models are abstractions from reality. And these models that you learn about use just the essential components that are necessary to conduct this optimization, or to apply optimization theory to solve problems. Okay, so when we talk about simplifying assumptions, it's really important that you know the assumptions, that you pay attention to the assumptions of the different models you learn, okay? I can't stress that enough. When I present, or when the text presents models in a diagrammatic form, be aware, look at the axes. What is it considering on the axis? What's not there? What's not? How does it introduce other variables, other factors? So that's what you should be aware of. And what's not there at all, what's not on the axis, what's not considered in the coordinate plane, what can you say about that? Is it okay that it's missing? So think about your assumptions as you're working through the material. So as I said, microeconomics is a study of behavior of individual consumers, business firms, and markets. While as I said, microeconomics, I'll just read through this, but microeconomics focuses on the routine business operating decisions managers must make to earn greatest profit under prevailing market conditions. So these are decisions like the optimum production level to maximize profit, how much input to use in order to produce a chosen level of output at the lowest cost, how much to spend on advertising, allocating production between two or more plants, and setting prices. Okay? So prices and output, and then other variables are the decisions made in microeconomics. Industrial organization, so this is managerial economics puts together microeconomics and industrial organization. Industrial organization is a branch of microeconomics, and it focuses on strategic behaviors to actually change the circumstances. So we're going to learn about different settings for business, and we always begin with the scenario of perfectly competitive markets. And when you think about it, in reality, we are faced with other sorts of markets, so we need to study those. So there could be the case of monopoly. There could be the case of duopoly. So monopoly is just one single business provider or service provider. Duopoly is where there's two. So an example, classic example of a duopolistic market right now is you have Apple and you have Microsoft as broader technology firms offering services. And operating systems. You could say they are oligopoly, like there's more than just two. So in strategic decision making, the idea is not to accept the existing conditions of competition as fixed, but to attempt to shape or alter the circumstances under which firms compete with its rivals. So to have any influence on the circumstances, to create greater profits, in some cases to protect and sustain profits in the future. So we spend a lot of time on perfect competition, and you'll see not until I think chapter 12 or 13 do we enter into industrial organization and really the use of non-cooperative game theory to assist in making strategic business decisions. Okay. So in the long run, for long run profitability, these are factors that influence long run profitability. So these are almost like these are stated in the reverse to the conditions for a perfect competition, really. So if you have many substitutes, then that's perfect competition. But if you have few close substitutes, that can contribute to long run profitability, singling yourself out among competitors. When the industry has strong barriers to entry, or entry barriers, this detracts from the case of perfect competition or perfect markets. When there's weak rivalry within the market, okay, so they're not strongly competitive. Firms are not undercutting each other to gain market share, and they're not disposed to do so. when there are not many suppliers, when consumers have little market power, when there's abundance of complementary products and limited harmful government intervention. So these are really variants from the perfect competition case, and all of those contribute. Each factor contributes to long-run profitability. Okay, so the chapter takes some time to discuss the difference between, or to clarify what economic cost is, as it's different from accounting cost. And it does this by explaining the difference between market-supplied resources and owner-supplied resources. Did I miss one? Oh, there it is, sorry. So, owners of a firm we can use, let's say, a private hospital. Okay, let's talk about for a moment, because they do a nice illustration of managerial economics in the health sector. So let's say there's a private hospital, and there's owners of the hospital. Let's say the owners of a hospital have also some buildings adjoining to the hospital that are just used for storage, and they decide that they have additional needs in the age of COVID. In the era of this pandemic, they decide to open a clinic for testing. They already own those spaces, those clinics, or those, actually they're just buildings off the main hospital building, and they decide to use them as testing clinics. When they consider, for accounting purposes, from an accounting perspective, the cost of using those spaces won't be included in determining how much taxes to pay. However, the fact is there is an economic cost from the perspective of the owner, because these are goods that are owner-supplied resources. Okay, these are owner-supplied resources. These buildings that are going to be used for testing are already owned by the firm, and they were used for something else, whether they were used for storage or whether they were rented out. That's irrelevant. Those buildings have a market value. Whether it's the cost of removing what was stored in there to store them somewhere else and pay for that storage somewhere else, whatever it cost, whatever the market would value those buildings at, is an economic cost that goes unrecognized by accounting valuation. So the text takes some time to explain this. This is a very important point, and this is an important point in finance as well as in economics, to distinguish between accounting and economic costs and profit. So market supplied resources are those that are purchased So employment, I don't know how to turn this sound off, sorry. Employment, that is, the employees that are hired, nurses, doctors, staff. Those are market supplied resources. Different from owner supplied resources. So total economic cost is the sum of all these opportunity costs. So that market value that we aren't realizing because we're using, for the private hospital case, we're using what we already have. We've taken it out of its whatever use it had before and using it for our purposes. So we're going to refer to the costs, the opportunity costs, differently. We're going to speak of the monetary opportunity cost of using market supplied resources, so the cost that we incur for hiring staff as explicit costs, and for supplies, and for any kind of transportation costs of those supplies, for equipment. Those will be explicit costs, but implicit costs are those that are non-monetary. They're perceived, however, as opportunity costs of using the owner-supplied resources. So there's three broader categories of implicit costs. Could be so the owners, let's say the private hospital has identifiable owners or shareholders. The investments or the shareholder value of those stakeholders is known as equity capital. So that's the money provided to businesses by the owners, either through buying shares or anything, or by holding shares, just holding shares in the company. That's their contribution. That's money that's locked in or that they've provided to the firm, in our case, the hospital. There's an opportunity cost to any land or capital owned by the firm. So they could have their own equipment. They can have their own MRI machines, their own, say they had their own machines for testing PCR, conducting PCR tests for the testing for COVID, or testing for the SARS-CoV-2 virus. So that property and that equipment owned by the firm that go into that new building would be those would all be considered opportunity cost. And there's also the individual owner's time. Time is money, they say, but not in terms of accounting. In terms of economic cost, this would be an opportunity cost. So it is the case that there's a total economic cost if you account for both. So this is all the explicit costs of market supplied resources, the labor, the supplies, the equipment that are purchased. And you would have to add to that those implicit costs. These are returns foregone by not taking the owner's resources to the market. So not having used that building for other purposes, not using the PCR test or selling the PCR, the equipment to conduct the test, staff that you're taking out of their current responsibilities and you're moving them over to that clinic where you're conducting the virus testing. Those are all implicit costs, and together they contribute to the total economic cost, the total opportunity cost of both kinds of resources. Accounting profit doesn't account for implicit costs. From the perspective of the firm, the owners are interested in all costs with the objective to maximize economic profit. Okay, this is a finance. This is what we learn. This is what is emphasized in finance, in the field of finance. So you have to, in any kind of valuing a firm, you would look for all of those opportunity costs. And when considering the value of a firm, whether you're in the market to sell the hospital or to sell your company, or if simply you're looking for other shareholders and you want to quote them what the value of the firm is, you would conduct this exercise. Okay, you would try and estimate the value of the firm. So it is both the price for which it could be sold, and it's equal to the present value of expected future profits. So when it comes to a corporation is owned by shareholders, right? And shareholders anticipate getting something in return for holding stock in the company. So they get they get some dividend that they're promised in the future, right? If they hold on to the stock, and they can also get the benefit of the market value of the stock. Any change in market value is figured into the stock that they're holding at the present time. So valuation of stock and the valuation of the firm are tied in a corporation and in any actual structure, but this is just an easier example because I can talk about the shares. But we understand that in finance, we have to consider TVM. What's TVM? This is the time value of money. I can't write very well on this. I'll do my best. Well, maybe I should use, just a second, I'm going to use the typewriter. It's just so messy. I did mention I got my new iPad, but it doesn't, it's incompatible with my old computer, so I can't even use it to stream. I have to figure out what to do. I'm not in the market for a new computer right now. But a new computer would stop that static sound. Okay, so this is can you see that? I don't know why it's so small. Okay. I don't know if you can see that. That says time value of money. Don't know why it's so small. So I just see some comments. So Mario was asking if we, anything that's a cash flow is an explicit cost. So cash flow is actual money in your pocket or money out of your pocket. I'm hesitating because cash flow does include depreciation, which is not an explicit cost. So I'm not going to equate the two. So from Mario's comment, okay, I'm going to write it like this. So cash flows include depreciation, not depreciation, but includes the tax savings as a result of depreciation. I'll explain this in a minute. Okay, so cash flows include tax savings as a result of depreciation. So it turns out a firm can purchase equipment, and or let's say they can purchase vehicles or machinery, and then choose to depreciate the. So the idea is that the equipment and the vehicles, they experience wear and tear over time, which is a cost to the firm. And the firm's allowed in accounting by accounting, generally accepted accounting principles, to depreciate that loss as a cost. So that goes into accounting, and then that reduces taxable income, and you incur a tax savings as a result. But the tax saving isn't seen as an accounting benefit. You don't put it in accounting that you get a tax savings. It's just that it lowers your taxable income. However, in finance and from a cash flow approach, you would see those tax savings as a cash flow. So that's why I'm differentiating between the two. So yes, it would you can't equate cash flows with explicit costs. Cannot. Okay, so then the other question, Manuel. So if owners use their equity, the equity is, they can't use it for anything else. It's locked into the firm, so there's an opportunity cost for that. Yes. So let me describe. If you guys can read that, okay? Is that too small? So limited here. I don't know where my typewriter went. There it is. There it is. Okay, let's see if I can make this bigger. Ah, there we go. Very good. Okay, so when considering the value of a firm, in other words, to find the price for which it can be sold, you need to find the expected future profits. And we'd like to do that in terms of economic profits, okay? So I'm going to just put a note. For firm valuation, we want economic profits. But we're confronted with a time value of money consideration. Over time, from an economic standpoint and from the perspective of finance, money that accrued in the future, the same amount today would be worth more. So $1 in the future is worth less than $1 today, right? That is an example of the time value of money problem. And how do we deal with that? How do we deal with the fact that $1 today is worth more than $1 in the future? And how would we add up these future profits in any meaningful way? So we have to consider R, the risk-adjusted rate of return. Okay, so what is that? So these pies here, these symbols here are the profits in each period, okay? The value of the firm, if the firm has a finite life, so a firm could have a finite life if, well, it's feasible, right? It could be that it's a family-owned business and it's clear that this generation that's running the business is not interested in passing on, or the current owners are not going to sell the business. Sorry, they're going to sell it, but they're not going to pass it on. The firm is going to cease, and in its current form, to cease to exist. And it's possible, right? Just whether we'll know exactly when or not is an assumption. We could say that so let's say a family-owned business, people are in their 30s and they plan to run it for the next 20 years. Let's say 30 years. And then that's it. So they anticipate these profits 1 to up till 30. But these are out in the future. So that amount off in the future is not the same if I was to get this amount today. So we have to apply this discount rate. Where does this come from, this idea of the discount rate? This is what we call this. It's the risk-adjusted rate of return, R, or you may have heard it referred to as a discount rate. It actually comes from the existence of financial markets. The fact is, let me see if I can illustrate. You know what, I'm gonna turn my iPad on for a bit. Let's see. Give me a second. No, it won't let me work. It won't let me turn it on. So I'm going to just illustrate it here the best I can. I have slides for this. I should just show you my finance slides. So you might have learned this before, possibly, likely. Okay, so what you have is two options. You have two options. Either you can have $1 today, or you're offered $1 next period. So 0 is today and 1 is next period. Now, I can't compare these dollars because I understand that that this is another issue of opportunity cost, okay? That $1 that I have today, whether I do so or not, has an opportunity. The opportunity in this case, now notice the assumption is here that there's one R. We're going to use one R, so I'm going to use one R. Now that's not realistic in that there's many rates of return available out there, but we're going to focus on one because it's the only one that is relevant to us. So there's an R that prevails. What is that R? The fact is that there are people willing, so because there's a market for borrowing and lending money, my dollar has a value next period of 1 plus a premium R. You can put it in brackets, you see it in brackets. Okay? So for every dollar I have now, next period, I could have a 1 plus R dollars if I gave it away, if I was patient and invested it or saved it, whatever the R is. Or I invested it back in my firm, if this is from the firm perspective. For every dollar the firm has for investment back into the firm, there's a return on the investment of R. Oh, I lost my R. Okay. Okay, so the R in this story is the return that you could get by investing in the firm. And if you didn't invest in this firm, then you would take that money, like we talked about, the value or the opportunity cost of investing in this firm is investing in another firm, earning R for every dollar invested. Okay, so this is the idea of opportunity cost of that dollar. Now, what does that create? Beyond saying that a dollar can become 1 plus R, a dollar in the future is worth what today? I'm sorry if it's slow for some people, but I hope this is worthwhile for others. So what is a dollar in 1 year or one period worth today? So you see, I can compare these two here and say, I prefer, this is why you would say you would prefer option one, $1 today against $1 in the future, because in the future that's worth 1 plus R. And I compare that to the dollar here. But now the next question is, what is the value because of the opportunity cost, or the opportunity of the return to investors in the firm? What's the value of $1 in the future? What is the value today of $1 in the future? Anybody? Anybody know? For my 21 viewers, 20 viewers? Okay, Manuel knows. Ah, okay, Isadora has a suggestion. So this is not an additive concept, right? It's as Manuel showed you, it's a division that you have to do. It's a factor effect. So let me show you a little clearer here. So it's $1 For every dollar invested at 0, it becomes, I need to make my timeline again. I'm just gonna write this a little bit differently so you can see it. I'm gonna write it for every dollar invested. So that's like $1, right? There's a factor of accumulation 1 plus R. You still get the same result as 1 plus R, but I'm trying to show you the factor of accumulation. Okay, so that's a factor of an accumulation. Now, if that's a factor of accumulation, we need the reverse. It's a factor, you multiply it or you divide it. So on this side here, let me erase this check mark. So if it's $1 in the future that we're going to receive, what is that worth today? It would be worth it would be worth 1 over 1 plus R, which is a smaller number than $1, right? Because it's divided by a number bigger than 1. So this amount is smaller than that amount. So what does it mean? And let's put some numbers here. I don't know if we're going to do that. No, let's put the basic formula. I'm going to just put the basic time value of money formula here. And you know, you don't spend a lot of time on this, but this is really fundamental. That's assumed you understand this, so I'm just going to show you here. I'm going to use little t. I can't do this in any feasible way. Okay, I have to, all right. So you might have seen this expression in the past. So there you have a future amount is equal to a present amount multiplied by a factor, an accumulation factor, 1 plus R, for as many periods as have transpired T. You can also write that as you guys can copy this out if you're learning this for the first time. Or you could write this as from the present time, now, so 0 is for now, today. You could solve this mathematically and it looks like this. Now I'm making all these fancy formulas, but it's really just one again and again. Okay, so I'm just taking this formula and I'm solving for the present value amount. And I get this formula. Okay, it's so this is known as discount factor, or the discounting that I do. And what does it say? If I was to put numbers on this, let's say R was I'm just hesitating because it's frozen. If we were to make R a number, make it 10%, and we think of $1 as $1 million, what would you get for this amount here if R was 10%? If I'm going to round it, it's like 91 cents for $1, or if it's a million, it's $909,000. Okay? So what does it mean? It means that $1 in the future is worth 91 cents today. Because of a prevailing risk premium, I have the opportunity to do something with the $1 that's coming. Even though I'm not going to get it till one period from now, I could borrow against it. I could borrow 91 cents for every $1 I got, or I'm planning to get, and borrow that money and do whatever I want with it. And because I know, if I know $1 is coming to me in the future, I can pay it back, right? I know that I could pay the amount, the 91 cents that I got today. I could pay it back because I'm getting $1. So let me repeat that. So I know I'm getting $1 in the future. What is that worth to me today? If I know I'm getting $1 in the future, I could act now. This is a dollar sign. I could borrow 91, because markets are available to me with R, 10%, I could borrow 91 cents for every $1 I'm planning on getting. And then when I get it, I'll pay back what I owe. In the meantime, I had the 91 cents for every $1, and I did something with it. Either I bought stuff or I invested it somehow to try and get more than the 10%. Okay, so that's why $1 in the future, in the ambiance or in the circumstances of R, an existing risk premium or opportunity cost of doing nothing, I could actually act today. You get it? So also I see here that in 91 cents, I could compare the 91 cents with the dollar today, and certainly that's, it's better to get $1 today than 91 cents in the future. But what I'm trying to explain to you is what $1 in the future is worth today. And it's worth 91 cents. Okay, now spend a half an hour going on that tangent, and hopefully that was worth it to you. So that's why we have this thing on the bottom, this factor on the bottom, the discount factor. So for every amount coming off in the future, for one period, we discount by one factor. For 2 periods in the future, we have to discount for 2. And for t periods in the future, we discount by t. And if this is finite, we would just add those up. So this is feasible. I mean, it's you could come up with numbers. You could come up with different scenarios to try and estimate the value of the firm. Notice the assumption here is that R stays the same. Okay, that you're going to use the same discount rate every period, that it's always available to you, or you're setting that at the outset and saying, well, if I don't invest back in the firm, this is what I require for my money. I want that R in each period, or each year in this case. A very important assumption to doing this, okay, so there's lots of assumptions here. There's that it's going to be finite periods, that the R is the same, and we also assume, this is really important, that your decisions that you make in one period about maximizing profit don't influence future decisions or future costs and revenues. Okay, so they're independent. Anyone who took my class in statistics knows I spent a lot of time on independence. Okay, so this is a really big assumption. This is the difference between saying, well, what you do today could influence future profitability. Well, we're assuming it away. We're saying, well, no, because it's independent from future costs and revenues. Okay, so that's assumption here. Any comments? So you guys can review this video and you can ask me questions about it too. You can put comments in the comments section regarding this point. So the last thing to do regarding maximizing the firm, and I hope you're okay with this FV. I didn't define my terms here. Let me just write this here for people who are just scratching their heads. What is she doing? This is future value. I think the book is very thin on background material and assumes a lot. It assumes you know statistics. It assumes you know finance. It assumes you know, statistics and finance. Yeah. And calculus. It assumes you know that too. So I do a lot of remedial stuff with you. So in P means present value. Okay, So you see the pattern. The important thing is to see the pattern. Now what I'm going to do is say, well, what if a firm isn't finite? What if it's an infinite existing firm? And that's possible with a corporation. In the corporation, ownership is transferable with shares. So even if the owners and managers, people running the firm, might retire or die, other people will replace them, and owners could be bequeathed, like someone who owns shares might pass it on to their children or to other heirs, relatives, or friends, or they can sell it. They can sell their shares in a company. So you're not tying ownership to management. Those are separate. We'll talk about that in a bit. And so it's possible, and lots of the modeling and the valuation models for firms build on this assumption that the firm could exist forever. So how would you figure out the value of the firm if the firm could exist forever? It turns out, mathematically, that this would be the value of the firm. Now this should look familiar to you from high school, except maybe the letters are different. So what we're saying is these these profits, which are revenue minus cost, right? So let me make a point about that too. Pi is equal to net revenue, let's just say that, or revenue minus cost. In case you're really lost, that's what that is. And let's say this goes on forever. It doesn't just go for t. So this is the formula for the value of the firm. That's because, let's say this is the price. Let's call this the price of the firm. Or the present value. Okay, so I can use present value or price. I just want to use the same symbols so you're not confused. So that would be the present value of the firm, or the price. And let's say the profits in each period are the same. Notice that's the other assumption here. So the assumptions here are R is the risk-adjusted rate of return. That's our discount rate that we're going to use. That's the rate of return we expect. And we've adjusted for the risk associated with it. We're using the appropriate one. And it's the same forever. And this is also, pi is the same forever. And what else is the same? No, that's, and it exists, and the firm exists forever. That's another assumption. So then you're going to get pi forever. It's like the value of the firm pays R forever each period to give you pi. So just think about that. That's the value of the firm that earns a return R, which is equal to pi always. That, if you solve that algebraically, isolating analytically for PV, it's very simple to see the price of the firm is equal to, or the value of the firm, we like to say value, but it's price that you could sell it for, is that. Okay, so again, every model has inherent assumptions, and there you go. Is that okay? Any questions? You see the math there? Then they, so if everybody's fine with that, obviously, you know, we made a lot of assumptions to come up with pi and a lot of assumptions to come up with R. What's the profit you're going to use? What's the discount rate? So these are, you could come up with different scenarios to try and value a firm, and this is done in mergers and acquisitions. It's this is a foundation of the exercise of valuing firms, to know how to do it with these specific assumptions. Okay, Manuel gets it. All right, so the text goes through common mistakes made by managers, and it introduces actually a study that was performed. And it was very interesting. And you'll see, if you aren't aware with these results, you know, we will always fall in managerial economics, and economics, we always fall on marginal analysis as our decision-making tool. We look at the margin. We look at what's the effect of one more unit produced, for instance. What's going to be the effect of that? What's going to be the effect of that on our profit? What's going to be the effect of that on our costs? Okay. However, there's some instinct that's been revealed, and it's just kind of common sense, but also it's been studied, that shows that's apparent when you do these studies. There's an instinct that firms will, when confronted with rivalry, here, when firms have to make decisions, it shows a high price strategy versus a low price strategy. If a firm's not looking at its competitor, it's going to opt for, it's going to compare these two. So these are compared by the firm. CF means compare. I don't know, that's Latin probably, and I knew what it meant at one time. But I'm going to compare 40 and 80 million, where it's clear the firm would choose the high price strategy. However, when firms are presented with rival firm decisions, they might opt, and they tend to opt in experiments conducted, they opt to beat their rival as opposed to, and win market share, as opposed to comparing and choosing the better outcome. So these are the effects of behavioral finance or behavioral economics. They're very interesting results that are found in experiments and research like this. So the advice is that it's not market share. In this case, you shouldn't choose market share. You shouldn't try to win market share. You'll do better by just leaving the high price and making more. Now, remember, profits or revenues are made up of both price, and quantity sold. If you increase your price, the quantity sold might go down, but depending on the demand curve, and we're going to talk about this, you might still do better. In this case, you could do better by not winning the market share. So you're going to lose quantity sold, but you're going to do better. You're going to make more. Okay? So these are common mistakes of managers to try and win market share as opposed to just looking and focusing on profit maximization through optimization. The text also explains some examples about focusing on profit margin, which won't maximize total profit. So you should read these again, okay? I'm not going to go through them. They do a nice, a brief introduction, but by the end of the course, you'll have seen all these cases. Maximizing total revenue reduces profit. Again, this is a trade-off between cost and revenues. And cost plus pricing formulas don't produce profit maximizing prices. So you'll see we're going to cover these throughout the course. Okay, so I mentioned in the corporate form of corporate structure of business, it is the case that the owners are not also the managers of the firm. And in other business structures, it could be the case as well that the owners, or we say the principal, is not the manager and the executive of the firm. We refer to the executive as the agent. The agent is responsible for formulating and implementing tactical and strategic business decisions that will further the objectives of the business owner. So the manager acts on behalf of the business owner, and this could be in several forms of, in the corporate form or the partnership form of business. You have this separation between the principal and the agent, this distinction between them. And this can create a problem. It could be the case that the manager acts on his own behalf to advance his own interests, which effectively reduce the value of the firm. So this has been recognized and studied, and of late, some researchers have taken issue with this as a cornerstone of finance and managerial economics, because they say, why should you assume this problem will exist? Why are you teaching future managers that they need to be compensated not to take actions against the value of the firm or against the firm? So it's very important, any kind of education is complemented with ethics discussion. So I'm saying it here that, it's not a given that a manager is going to do this. There should be some costs associated with reducing the value of the firm, that his reputation will be affected and he'll have problems. That this works into a negotiation. An employer's employment contract would actually protect owners at the outset who were concerned about this from any kind of malfeasance by designing incentives and penalties for these actions taken. So often an incentive that you find out about or hear about are stock options. In the corporate sector, some stake, maybe bridging that relationship between that relationship between ownership and control, or that separation between ownership and control, is to actually make the manager a part owner in the firm. Give him stock options. Give him stock. What were some examples of penalties? What are some examples of penalties? Let's take a 5-minute break and we'll come back and talk about penalties and hopefully finish this chapter soon. Okay, I'm back. So if you took a moment to look back at the text, you realize the idea of the complete contract is a hypothetical. It's a hypothetical notion that you could even make such a contract. It's a proposition that if you were to make such a contract, you could work in incentives like stock options and then penalties, but it presumes that you would have to monitor to a great extent, have a whole other branch of your, like a department to monitor your managers. And this can get very expensive with, it'll cost you, and also it wouldn't be great for morale, would it? So they suggest, even though this is a hypothetical construct, it's not so far-fetched to do some of this, right? But to believe you could impose this and have it cost effective, that you're not going to spend more money on the monitoring than you're going to save in firm value or profits over time, is a stretch. So they explain, it's explained that there's hidden actions that the managers can take that can't be observed without a significant monitoring effort. So they could have, with insider information on the firm, they can make deals for themselves with other firms, or they could just be looking out for themselves, making a plan to work for another firm. And the owners wouldn't even know it. These hidden actions that could harm the owners of the firm, but further the interests of the managers. We refer to this as moral hazard. So, as I mentioned, the control mechanisms that we see stick are manager compensation that include an amount of firm's equity, so making them part owners. In terms of the board of directors, so remembering in the corporate structure of the firm, the board of directors are the principal who hire, they are the board of directors, I gotta specify, are the agents of the owners as well. So having a percentage of the board where they are acting like agents, so before I was talking about managers being the agents, the board of directors are acting as agents of the owners. So have some outsiders that are serving as a check and balance on the board of directors. And another thing to do is to finance in the corporate structure with debt instead of equity. This is another check. So you're going to take on bondholders so that those managers have to be accountable to the bondholders. So they're also like outsiders. So bondholders have a stake in the company. They have a promise from the corporation to pay them a certain amount on a certain date in terms of interest payments that are set out by the bond certificate. So they have a commitment. And if you follow anything about the example of the government debt, you see that creditors can take their the firm or the government to court. Okay, the company is liable to its bondholders because they made a commitment to take their money, borrow their money, and pay them set amount at certain time periods, either in terms of interest and or the face value of any bond at maturity when the bond comes due. So these are known as internal control mechanisms that help resolve the principal agent problem. If the value of the firm is affected, so too will that's what goes without saying, also the value of stock in the firm will be affected. And what this does is make the value of the firm and stock value drop. So the value of the firm and stock value drop low enough so that the company can be bought up by either another company or another group of shareholders. And with those shareholders, the new shareholders will vote out the current board, so get rid of those agents and get new agents and do things better. So the firm can still survive, but there would be a correction. So this is an external mechanism, corrective mechanism. I guess another company. Okay, questions? I'll say and. Okay. Okay. We're going to distinguish between the different types of firms. The characteristics of a price-taking firm and a price-setting firm. Those are the extremes. A price-taking firm cannot set price of its product. Price is determined strictly by market forces of supply and demand. So this is a the example of perfectly competitive market. The price setting firm, it sets the price. It has a degree of market power, which is the ability to raise price without losing all sales. So the extreme example is the case of Monopoly, where they have total market power. So what's a market then? A market is any arrangement through which buyers and sellers exchange final goods or services, resources used for production, or in general, anything of value. The advantage of markets are that they reduce transactions costs for both parties. So it brings them together, it brings the buyers and the sellers together, and they don't have to incur the search costs of finding each other. Okay? Now, search costs like any kind of delays, time. Just for example, so right now we have, for the last 25 years, we've had the internet, and that's made markets available, many markets available to many people on both sides, the buyer side and the seller side. You don't have to, well, there are different costs now because you have to filter through so many options. You have to read reviews if you're going to buy products as a consumer, or if you're in manufacturing, you're looking for inputs, and you have to read so many reviews. But definitely there's a benefit that you get to see so many options at once. It actually makes it a better market than if you were to search yourself without the internet. You might just depend on referrals. You might depend on local suppliers, and on the consumer side, you would depend on local consumers. So the point of the market is the degree to which the characteristics are a perfect market, and the way, we use the perfectly competitive market as the baseline, and then we abstract away from it. Or actually, it is an abstraction, because perfectly competitive markets are difficult to, perfectly competitive markets are the extreme, and markets are depending on the different characteristics, more perfectly competitive than others, or more competitive than others. So the market structure governs the degree of pricing power possessed by a manager. Market characteristics that determine the economic environment in which a firm operates include. So these are the characteristics we look for. And you're going to see these again and again. So get used to them. The number and the size of the firms in the market, the degree of product differentiation. So you're going to notice these are like the flip side or you've heard these already when we looked at long-term profitability of the firm. These were factors that played in to profitability. The likelihood of new firms entering market when incumbent firms are earning economic profits. So the barriers to entry. So how easy is it? So once Facebook started, I don't know if you noticed or you were in social media in 2006, but many platforms tried to rival Facebook, and no one seemed to be able to do it. Facebook did it first and did it best, and they maintained themselves in social media for many years. Now you have Facebook as a social media platform. You can distinguish it probably from something like LinkedIn that is for business purposes, and LinkedIn has singled itself out. It's found its niche. It's also a social networking platform, but distinct enough from Facebook, and many people have both accounts, right? Or hold accounts in both platforms. So they managed to differentiate between themselves and retain market power. But Facebook was standalone for a while, although you saw many trying to replicate what they did. They just couldn't reach they couldn't get the market share that Facebook did. Okay, so the barrier to entry would be just the branding of Facebook above the others. Okay, so you need to distinguish between, did I miss something? Okay, so we're going to distinguish between the meaning of the short run and the long run. And so too, when I speak about strategic decision making and industrial organization and game theory, we refer to long run strategies, because we imagine that that's a period of time. So it can vary from industry to industry what is a long run, but it's a period of time in which all factors of production and costs are variable. But the short run is where at least one input is fixed while the others are variable. In the short run, firms are only able to influence prices through adjustments made to production levels. So that's a very important characteristic or horizon to distinguish the short and the long run. So perfect competition is where firms are price takers with no market power. So this is the extreme case, where you have lots of firms and they're small, so nobody's very big. Undifferentiated products and no barriers to entry. Any economic profits earned would vanish when as new firms enter. So we use as examples the agricultural goods and other commodities traded on national and international exchanges. That's a good example of perfect competition. So like rice, soybeans, etc. These are major factors of production in the food industry. And the other extreme is the monopoly. On the other side, it's just one firm as opposed to many. It produces a single product with no close substitutes, and it's protected by a barrier to entry, which allows the monopolist to raise its price without concern that economic profits will attract new firms. So recently there were some hearings with the tech industry leaders regarding their behavior and questioning their monopoly power. So I don't know if you saw those hearings. There were Senate hearings, and there was all the big guys from Twitter and Facebook and not Instagram, but it was Google. That's right. And you can think about it, Google is ubiquitous, it's everywhere. Do they have monopoly power over information, over price setting, access? They certainly do. Some of these, who is it? Patreon. Patreon as a platform for contributions, so people can contribute through influencers through Patreon. So internet influencers use Patreon to a point, and then Patreon just censored a number of its users, and right now they're being they've been taken to court for doing such a thing. So these firms, if there's only one doing what they're doing, people should be able to have access, and it's going to be questionable whether they're in some antitrust violation. Microsoft was brought to court in the 90s, and they had to break up some of their business as a result, some of their operations. They had to pay fines of antitrust. So monopoly they do exist in the public sector, and they are permitted in Puerto Rico. The Energy Authority acted like a monopoly, or was a monopoly, and currently the Water Authority is a monopoly. So there is some argument for having a monopoly, but it's been challenged of late in Puerto Rico. Even in Canada, where I'm from, the energy provider, they generate hydroelectric power, and they recently went bankrupt. So it's not the monopoly form is not necessarily the most efficient, not even the public sector. Monopolistic competition is a mix of the two, where you have a large number of relatively small firms. You have differentiated products, which gives the monopolistic competitors some degree of market power. The firms are price setters, but there's no barrier to entry. An example cited here was the toothpaste market. They all coexist, but there's few of them. I recently learned about the glasses market for frames. I think it's only one company or just a few large companies that nobody's aware of, because you have brands buying frames. All the different brands are buying frames, but the frames are coming from the same place. Oligopoly is where you have a few firms that produce all or most of market outputs. In the oligopoly, profits are interdependent. And so this is where a lot of the industrial organization game theory applies in oligopolistic, oh my goodness, oligopoly markets. I'll say it like that. So this is where and then there's just a point about globalization and the effects, the impact as a positive and as a challenge. The integration of markets worldwide provides opportunity to sell more goods and services, but presents a threat of increased competition from foreign producers. And we'll talk some about that later. So we're going to focus on marginal analysis. We have to also focus on economic profits and not accounting profits. Be wary of separation of ownership and management. And to distinguish between price-taking firms, broadly between price-taking firms and price-setting firms. Price-setting firms have a degree of market power, but price-taking firms have prices determined by market forces of supply and demand. So we focus for the first several chapters, I think it's 10 chapters, on price-taking firms. Okay, so we're going to learn about supply, market forces, supply and demand. Okay. Okay, in chapter 2, you learn about you learn about demand, sorry. We start with a chapter on demand. And then supply and equilibrium. Okay. All right, so this notation QD represents the quantity demanded. This is distinct from the demand function. Okay, so this is just the quantity, the amount of a good or service consumers are willing and able to purchase during a given period of time. Notice I have to specify all that. Those are all the assumptions in writing QD. The demand function traces the quantity of demand, the quantity demanded. The quantity demanded depends on many variables, as you've seen in the first chapter. Several variables influence the amount, the amount demanded, or the quantity demanded. The price of the good, the more costly it is, it's a tendency. If something costs more, people want less of it, right? Just because of their limitations. Ultimately, their incomes then are going to influence the quantity demanded. The prices of related goods. So one second, give me a second. It says related goods, which are, we're going to refer to them as substitute goods, but they use an R here, okay? So those are good. That's the alternative. So it turns out that if we're looking at buying a textbook for a course, a substitute, maybe it's not a great substitute, but a substitute for a textbook of the 13th edition of a textbook, a substitute could be the 12th edition that's being resold on Amazon or in Facebook. Okay. The taste patterns of consumers could also figure into the quantity demanded. Maybe someone, when it comes to textbooks, they like new textbooks. They just don't want anyone to have touched their textbook before. They want it new and wrapped in plastic and no one having touched it before them. So that's just a preference. So that's going to affect the quantity demanded. Expected future price of a product. Just to be clear here, for the prices of related goods, let me just go back. Because the related good depends on the relationship with the good. It could be a substitute good or it could be a complementary good, right? Expected future prices can affect the quantity demanded I don't know if you saw the Seinfeld episode, if any of you watched Seinfeld, but there's a great example of knowing that a product is not going to exist anymore in the future could raise, depending on how loyal the customers are, could raise the quantity demanded for the product. They might just, individuals might want to stock up if they think it's not going to exist. Oh, there's the example of toilet paper. With the announcement of shutdown, communities or societies or economies shutting down in March, people ran out to do something and they bought up all the toilet paper they could find. So it wasn't that they expected prices to go up per se, they expected there not to be any product. But if prices are to go up, that's also going to, or the anticipation of prices going up, that's also going to create a sense of hoarding. The action of hoarding. Also, if you buy it up, I don't know if you saw the case of individuals who bought up all from the internet. They just bought a bunch of sanitizer. We're talking like 10,000 boxes of sanitizer, so that they could sell them, turn around and resell them for a higher price. So that's also going to influence the quantity demanded today. They just increased the price today. The number of consumers in the market also will influence the quantity demanded. More people, more items. So these are the factors that influence the general demand function. And this is the quantity demand, so that's the point on the demand function for every combination of these variables. Now there might be more variables, but those are the standard ones that we use. It's a tendency to express them, the variables, at the outset, at the beginning, we're just starting, as a linear function. So we're going to present those variables related through a linear function. It means the standard linear function that you know about from high school, I hope. That's a linear function. So here we have the A, so that's the y-intercept, right? A is the y-intercept, and B is the slope. It's the same here. A acts like the y-intercept, and the letter in front acts as the slope for each variable So, what is a slope? How do we interpret slope? We need to take a moment. So if you had the function y equals 1 plus 2x. How will you interpret the slope? Let's say, I'm just going to make this simple. We'll start with a simple example and then I'll put it in terms of the demand function. So what is the slope? How do we interpret the slope? Oh, better? There. Is everybody okay with me writing it like that? 2 is the same as 2 over 1, right? So, what it means is, start on the bottom. For a 1 unit change in x, there is a 2 unit change in y. So what a line is, a line is a relationship between an infinite array of points. So I can go from the lower point on the line to the upper point on the line with this relationship. So if I started here, and I increase the horizontal axis, so this is all in the XY plane, right? X this way. I don't know how far back I have to go for you guys, but I'm gonna go very basic. So this is the XY plane. If I increase X by 1, so if I go over this way by 1, to get back on the line, I have to go up by 2. That's the relationship between the two. So let's look at this, let's put it in the terms of the demand function. In the demand function, you have many different x's, right? You have price, you have income, you have price of related good, you have taste preferences, you have expected future price, and you have number of consumers. So let's just look at this one. Let's take this B. So let's write, what does B mean? B means where you're going to treat this P as X and the Q as the Y. We say for 1 unit increase in price. So let's put in the terms of the price. Let's make it $1. Oh, geez. So that's what it is. So you start, it's B, you imagine it's B over 1. So this is like B over 1. And you say for a 1 unit increase in X, which is the P, so in price, QD, which is the Y, increases by B. Okay, so take that as your standard definition. I did it in this positive, but we could also write it in the negative, right? Because it's just the relationship. So it's similarly, I could write this as $1 decrease in price, QD decreases by B units. Now if B is a positive, we usually, we'll interpret it as the first, in the first way. And if B is negative, we interpret it in the second way. Well, no, that's not accurate. What we'd have to do is, this would be the standard interpretation, but if B is a negative, it would be the reverse. But I'm interpreting it as though B is a positive. So anyway, when we get to it, we'll discuss it because it's coming next. Okay, so that's so that is the slope effect. That is also what kind of effect? What do we call that? There's different terms for it. You could call it the partial, oh, I wrote it in Spanish. It's the partial effect or marginal effect is the slope effect. So people in the class who are engineers and good at math, this is maybe boring for you, But other people, this is it. This is what we're going to spend a lot of time on, margins. And I have to add, I didn't add in the notion that my interpretation, because there's all these other variables, I can't just ignore them. Here it was easy up here to say 1 unit change in X results in a 2 unit change in Y. I didn't have any other variables to talk about. But in this example, what in the world, how can I say that the price change here isn't going to affect other things, other variables? I have to make an assumption that we can do this while holding the other variables constant. Okay, so I say income doesn't change, the price of other goods doesn't change, related goods doesn't change, tastes don't change, and future prices don't change, and the number of consumers doesn't change. I'm going to say that doesn't change, and then a $1 increase in price, QD increases by B units. Now, it's not necessarily the case that other prices or other factors won't change. But that's the assumption when we make this interpretation. The sign of the parameter shows how the variables are related. Okay, so a positive sign you interpret as a direct relationship, and if it's negative, as I mentioned, this is an inverse relationship. Okay, some points to make about different kinds of goods. A normal good is what we often work with in economic theory, but we have to talk about the non-normal goods as well. A normal good is a good or service for which an increase in income causes consumers to demand more of the good, holding all other variables in the general demand function constant. So what I'm saying, what I'm focusing on when I make this definition is this variable. Okay, the normal good definition focuses on that variable and says that C must be what? So for a good to be a normal good, then C must be positive, okay? That is that when income increases, the person wants more of it. That's in contrast to an inferior good. An inferior good is where C turns out to be negative. That's where income, additional income, will mean that the person or the individuals or consumers buy less. So an example of an inferior good would be canned goods or macaroni and cheese is a classic, like the boxed one. you have more money, you're less likely to buy canned goods or macaroni and cheese in a box. Oops, I meant to go up. Okay. And then there's this terminology that we have to clarify between other related goods. Goods are substitutes if an increase in the price of one good causes consumers to demand more. So there's a trade-off where a substitute goods price affects the consumption of your product. A complement, so an example of a substitute, so in the some people wouldn't agree with this, but in the car industry, you could trade, substitute Toyota and Honda. Comparable cars. Complements are goods where increasing the price of one causes consumers to demand less of the other. So goods that are consumed together. So what goods are complements? Rice and beans. It could be complementary goods. If there's an increase in price of rice, if they're complements, if you believe they're complements, then price of rice goes up, people buy less rice, but then they're also going to buy less beans because they can't have them together. So anyway, here are some of the results. Notice, don't get intimidated by this notation if notation bothers you. This is just like the change in y over change in x that I explained at the beginning, right? So whenever you see the triangle, it means change. So, for the general demand function, it is the case that we should see B as negative, C is positive for normal goods, and negative for inferior goods. For PR, the D should be a positive for substitutes, but negative for complements. The relationship should be positive or direct for taste or preference, future prices, and consumers, number of consumers. So let's talk about those briefly. So preferences for the good increase, then the quantity demanded increases. That E, for each unit of however you measure that, an increase in taste creates a positive change in quantity demanded, and that means the E, that's the subscript, or sorry, the slope in front of T would be positive. Again, we talked about future prices. If the future price is positive for a good, that's a normal good, then anticipating the future price being high, people will buy more of it today, so that's why it's positive. And if there's more consumers, so for every unit of more consumers, you expect more quantity demanded. Okay, so that's the demand. That's what we expect. All right, so what we're going to do now, so now you understand the relationship between those variables. So again, we only isolated those. How many were they? We isolated 1, 2, 3, 4, 5, 6 variables, factors, as the main factors determining quantity demanded. However, we are going to depict the demand function in 2 dimensions only, and we pick price as the variable we're going to present it with. And we're going to do something else. Even though the quantity demanded is a function of all those variables, we're going to focus on price. We're going to use this fact that this is, we expect this to be negative. The higher the price, the lower the quantity demanded. We're going to refer to that as the law of demand. All else constant, all the other variables unchanged. So what we mean by that is if you were to look at any snapshot in time and fix all those variables from one moment to the next and only change price, we expect quantity demanded to go down. So at a different set of those variables, at a different snapshot in time, you might be at a different price and a different quantity, but still holding those constant. If the price the price rises, the quantity demanded will go down. So that works this way. I prefer to read it like this. If the price rises, the quantity demanded decreases. But it works in the reverse as well. If the price falls, quantity demanded increases. And this must be negative. It's not negotiable. It's the law of demand. So what happens to all the other variables? What do I do with them? There's 2 things I'm going to do. Even though we learned the relationship between quantity demanded and all those variables as a function, so quantity demanded is a function of all those variables, I'm going to isolate and look at P only and flip around the equation because I want to depict the relationship with price on the on the Y horizontal axis. It's very rude, isn't it? But that's what we're going to do. So it's always P on this axis and Q on the horizontal. And why do I do that? Because I'm going to marry this, I'm going to merge it with quantity supplied and same price, and I want this to be the same. So it's a convention of economics to do it this way. So if you were confused, it's understandable. So what we end up plotting is the inverse demand function. We flip it around, we invert it. So let's see what that looks like. This demand function is always downsloping. It's always a negative relationship. Okay? Even if I flip the axis, it would still be a negative relationship. Okay, so a point on the direct demand function, and we're going to talk about the demand, where this demand curve comes from in a later chapter. But what happened to all the other variables? They're all gone. Am I going to ignore them? First, we say that a point on the direct demand curve shows either the maximum amount of a good that will be purchased for a given price, or the maximum price consumers will pay for a specific amount of the good. So here's an example. So it turns out that faced with these prices, there's no one and no amount that will be purchased at $140. When the price is lower, 200 units are demanded. Okay? So consumers come into the market and they demand 200 units. This could be many different people demanding different quantities. These aren't necessarily the number of people, right? Some people could demand more than others. And as the price drops, more people come in and more units are demanded. So here's the first example. It actually shows the corner solutions. Of 0 units, so that's the extreme. And what we see, if I was to take these points and plot them, they would fit perfectly on a line. Now, that's not necessarily the case, right? It's just been done for this example, but a demand schedule doesn't necessarily have to be a line. It can be a curve, but it's still downsloping. In this class, and the examples and the text, some of the drawings show it as a line, but we really refer to the demand curve. Doesn't necessarily have to be a straight line. So how would we make this? So because it is a line, it turns out it is a line, you just have to take 2 points and you can draw the line, right? If we're aware it's a line. So you take 2 points and find the line. How do you do that? You do slope equals change in y over change in x. So the easiest would be to take the first 2 So I'm going to go from 200 minus 0. No, I'm going to do change in y. Sorry, y is going to be, I'm going to do this with price. Let's say I use this as price. I'm going to say this is y and this is x, right? I could do it the other way too. But I want price on the y-axis. So the change in y would be 200 minus 0. And then divide that by $120 minus $140. You see, I'm going to get a negative. So that equals what? A negative? One over 10. So let's put this together. I need to find the intercept, but I know the intercept. It's right here. When quantity demanded is 0, y-intercept is 140. So let's put it together. Are you guys with me? That's how you get this equation down here. that one there. You could also have done this in the using P for X and QD for Y. But you could invert to get the one below. Which one do you like? Are you guys okay with doing it with a function of P? Because that's what we're going to have to do, you see? And then this on this axis, you have price in dollars. And over here you have, let me highlight, quantity demanded. Oops. On the x-axis, horizontal. So if a price changes, it's a movement. You see a movement along the demand curve for changes in price. So the instinct to draw it this way might not be there because we always talk about price changes affecting quantity demanded. You know, the reverse relationship. But like I said, it's handy to draw it like this because we're going to merge the supply and the demand functions to get equilibrium. Okay, it's 8:45 and I should stop, but you know what, I'm going to keep going. If you need to go, you go ahead. I'm going to finish these notes and you can look back later at this. Okay, because I also want to make a video with teaching the calculus and doing some, maybe I'm going to send you a video because I already have one on the statistics review. You're going to need that for future chapter. But right now you need, well, you could use the statistics now too. So yeah, I'm just going to finish these. Let me see your questions. I didn't even look at your questions. If the price decreases, the demand increases. Yes, Mario. Right, Manuel. If D in substitute is positive and D in complements is negative. Right. And okay. And you guys can't see what I wrote there. Oh my goodness, disappeared. There. So you would invert this function to get it in terms of P, or just do it this way as I presented it here. Okay, I'm going to continue. Goodbye to those who have to go. I'm just going to continue here. All right. So graphing demand curves. So the change in quantity demanded occurs when price changes. That affects a movement along the demand curve. The other variables influence the demand function. Okay, so I'm distinguishing between a price effect, that is a movement along the curve that you see with the arrows here, and a change in one of the other variables will result in a shift in the curve. It goes forward or to the right for positive effects, and it goes left for negative effect. For instance, here, I have to make this bigger. I'm going to make it bigger here. So this is your same function. However, what do we do here? What could have made this happen? So if the income increased, let's say we started here at an income of $80,000, all else equal, all the other variables equal, and income increased to $80,800. So if this is the market, let me double check. Just double checking that this is because we're in economy. Alrighty. So if income increased, we could say total for all consumers. Is that going to be that? Then, because income for normal goods is positively associated with demand, the demand curve shifts right. So you have a right shift. a right or a shift forward. If demand decreases, if income decreases, it went for all else equal. Notice we kept the price the same when we did this, right? The price, it's a flat shift because we kept the price the same. We kept all the other variables the same. All that's affected is quantity demanded. So this is a left shift back. I'm saying it both ways. And these are just note the price remained the same, as do all the other variable quantities. Okay, so when we talk about this shifting, that's how it works. Now that doesn't mean, I made a parallel shift, but at different prices that shift doesn't have to be like parallel. At different price and quantities, changing a change in income doesn't have to be a parallel shift all the way down. But anyway, we won't get into that right now. Just showing you that it's a shift. So I showed you this for income, but I could do the same for all the other variables we talked about. Preferences, related product effects, etc. Okay? Now we're going to talk about supply. The quantity supplied is the amount of a good or service offered for sale during a given period of time. So just like quantity demanded, I specify a time period that that the supply function will be operational. These are the factors that influence supply and quantity supplied. So quantity supplied depends on the price of the good, I'm going to take a quick moment to see. Well, Mario's asking me. Thank you, Alec. Isadora, are you still there? Okay, let me go back. I'm going to go back. And I'm going to adjust my image. Isadora, what are you asking? Are you still there? Which page are you asking me about? Maybe she's gone. Okay, Mario, so now we change the income and the quantity demand function. Yeah, that's what we did in here. Income would have changed, all the other things would have stayed. So I know because of the slope on the income what this will be. So let me say something before I continue with this. This is really, with one variable, this is easy. You guys can do this manually, right? Well, maybe with some review, I just showed you how to make this equation with one variable. Well, one variable on the right hand side, so two variable. This is simple. This is a simple case of just a relationship between two variables, but this is a relationship between multiple variables. So to find this, you could actually find this equation. If you had all this data, if you had all this information for all these variables at the same time, in the same period of time, you could find the equation of this linear function in many dimensions using statistics. Okay, when it's just one variable and they all fall in a line, it's easy to do this. When they don't fall in a line, and it doesn't make a perfect line, but instead, let's say they were like, oops. Like all of your, so if I had, let's say, just the two variables of price and quantity, or if X and Y, look, they were not on a line and they were all over like this on a scatter plot, that's what you call this, I could use a line to estimate that relationship. That would also take statistics. So that's why I have to give you a statistics review, but not today. And people who already know it don't have to do it, so that's why I'm just going to post a video. Okay, so statistics will solve this for you to give you a line that best substitutes those points. That's not it. A line that best fits through those points. That's what we need. So to solve, we need statistics to do that. Having said that, I didn't even have to talk about statistics because all I wanted to do was explain to you how we view this function in two dimensions. So we just talked about the two-dimensional depiction of the function. Of price and quantity demanded. So this line here would be for given amounts I'm going to write it with the with my typewriter. So that line is for given levels of the other variables. If I change the levels of the other variables, then the line shifts. And it can shift in multi-dimensional ways if I change many at the same time. So I probably just change one at a time to see a mapping. So basically what you have, so we just talked about, if I changed income to make it, I would get a new curve, and if I increased income even more, it would go like that. If I decreased income, it would go this way. If I increase income, the curve will shift that way. If I just used income, but if I used other variables, it would go, depending on that relationship. Remember, if it's a positive shift or a negative shift depends on the slope parameter. So I've just shown one changing at a time because that's only feasible. I don't show on a graph like this two changing at a time. We always talk about one at a time. So that's what I wanted to say, that you realize that line is for given levels of variables, and that line is also, even though the numbers made it a straight line, it doesn't have to be, what am I going to say? Not that it doesn't have to be, but that could be determined by regression. That's what I mean to say. So that's why, even though I don't talk about it right now, I'm warning you that you have to learn to do that. So you're going to learn not to program it, but I'm going to teach you how to interpret regression output. That's the most important thing. So you see here, like I was talking about here, even though the observations make a scatter plot that's a bunch of observation all scattered, the line that you end up showing, or with, it actually has to go the other way, doesn't it? Because it's anyway, I'm not going to be able to pull it off, but okay, so it's downward sloping. It'll go like that. Even though it's not a great fit, that would be what we aim for, to find the line that best fits to all those observations. It'll make more sense when we do the regression, but the point is that these are simplifications where I give you data that fits perfectly on a line, like that. Okay, so talking about supply. So these are the factors that influence supply, quantity supplied. The price, and you can think about the effect on the quantity supplied, and we'll talk about those in a bit. Input price, prices of goods related to in production, technological advances, expected future price of the product, and the number of firms producing the product. So similarly, we have an equation, a linear equation. This would be the intercept. What is the intercept again? What does H represent? See if you're awake. I know, Mario. Well, in this class, you're gonna review the most important stuff from stats, so that might help you. Yes, the slope and regression are the most important thing, really, for these curves. Oh, anyway, tell me what H is? I mean, H is the vertical intercept. Well, in this case, it depends how we're going to write it, but okay. So think about that, what H is. I'll ask you in a bit. You guys didn't respond. Okay, so all these are the slope parameters, just like we talked about before with the demand function, the quantity demanded function. This is the quantity supply function. They measure the effect, the slope parameters measure the effect on the quantity supplied of changing one of the variables while holding all the others constant. The sign is very important. It shows how the variable is related to the quantity supplied. If it's a positive sign, we call it a direct relationship. If it's a negative sign, it's an inverse relationship. So let's go through these are analogous to the demand function, but you could have substitutes in production. Goods for which an increase in the price of one good relative to the price of another good causes producers to increase production of the now higher priced good and decrease the production of the other good. So producers as a whole okay, so these are whereas the demand function was looking at the consumers as a group. Now we're looking at the producers as a whole in the market. For complements in production, these are goods for which an increase in the price of one good relative to the price of another good causes producers to increase the production of both goods. So, can you guys see these? Okay, so substitutes in production. What's an example of substitutes in production? A good example for substitutes when car companies move from making trucks to SUVs. They were popular. Gerardo, yes, you're getting at it, but I wanted you to interpret the problem in terms of, well, the problem I gave you, but we're going to get to it, but you're right. Yeah, you have to interpret in terms of the variables I gave you. Can you see that? I think it froze. My video froze. What do I do? Let me see. Can you hear me still? Okay. So yes, if you see things freezing or blurring up, just reload your page. What are example of complements in production? I like to use the example of shampoo and conditioners. Let's say a new ingredient went to, so tea tree oil became very popular to put in shampoos. So let's say that was added to a shampoo product, but then they also increased production of conditioners that match with the shampoo, so people could buy them as a pair. I'm going to put my example. Can you read that? Yes. Cow meat and leather. Yes. Okay. So here's the relationships then. So in terms of the relationship between price and supply, as the price increases, there's a tendency for producers to supply more of the product. So that's a positive or direct relationship. For I, what does I stand for? We gotta get used to these factors. Not income this time. Inputs. As the price, the price of inputs increases, that's going to make the cost of production higher, so that will reduce the amount supplied. Inverse relationship. Now substitutes are a negative relationship with the quantity demanded, because they can trade off one for the other. And complements would be a positive relationship. Technology would have a positive influence. So the idea of technology is technology by definition makes production more cost effective or more efficient by definition. So yeah, that's a positive. And the PE was the expected future price of products. So E for expectations. So how does that work? Explain PE if you're there. Make a comment. Yes, the future expected price of the product being supplied. Why would it have a negative relationship? So the price is going to be higher. The interpretation is the price is higher in the future. Why should the amount supplied become negative? Now, these are general statements, and the degree to which, like how strong these effects are, depends on the product, right? But in general, yes, if you expect the price to be higher, you either withhold its supply and sell it later, or you produce it later when it's profitable. Right. Okay, and then F for what? The number of firms. Sorry. The number of firms. So the more firms, the more supplied, right? There's just going to be more people supplying, so there's going to be more supply. All right. So again, so this all looks familiar. You should all have a deja vu experience with this. It all looks familiar, except that now we're going to talk about supply. The quantity supplied is a function of price, holding all the other variables constant at a point in time. And we would have the supply function, but because we want to put it where y, the vertical axis is p, we have to invert the function. Remembering that any point on a direct supply curve shows either the maximum amount of a good that will be offered for sale at a given price. So that's the perspective of the firm. And then from the perspective of the buyers of the product, the consumer, it's the minimum price necessary to induce producers to voluntarily offer a given quantity for sale, the supply price. So again, I give you some numbers, and they fall exactly on a line, but that's not necessarily the case. This is just a simplification. And because this, okay, we could go with this 0 here. So this is the intercept of 20. So this is the intercept here for quantity supplied, remembering P is the vertical. So this is the y-intercept for x equals 0. So if you treat this one as x and this one as y, you would plot it and you see that it hits exactly at 20 here. And you guys should practice that you can solve this just like I did for the demand function. And there you go. So I leave that to you to practice. Remembering along the line is a change in quantity supplied. So if the price changed, that's all that this line depicts. This is just the relationship between P and quantity supplied. So if the price changes, quantity supply changes. So price goes up, quantity supply goes up. However, there's all those other variables. So what's going on with the other variables? Well, the other variables will shift the supply curve. So when one of the other variables or determinants of supply changes, the supply curve shifts depending on its relationship, the slope parameter being positive or negative. It will shift right or left. So here what you see so what could that be without knowing exactly? What could cause a supply decrease? What other variable? This is supply, Nivette. So let's go back to see. So what would cause the supply decrease? So let's see. Go back to our variables. So which one would be negative? So inputs, right? This one was negative. What else is negative? Substitutes and expected future price. So let's say that's its input. So input prices increase. Here input prices increase, so supply falls that way. So an example here would be input. I'm going to do it with my typewriter. That can cause a shift in the supply. What could cause a decrease in supply? What can cause an increase in supply? Go back to our list. What could cause an increase in supply? So these things look dangerously similar between supply and demand, but they are distinct. Of course, the supply curve is upward sloping. That's one thing. And then those different variables are used. So clear up in your mind what's the difference between those variables. All right, so what would affect a supply increase? Let's go back and look at the list. Other than price. Technology. What about technology? Technology has a positive effect, right? What else has a positive effect? Complementary goods. If the supply of a complementary good was affected, then there'd be more production of this good. Or if technology made supply more productive or made production more productive, that would cause a supply increase. So let's just say technology. Okay, so those are two examples. All right, so then whereas the most consumers are willing to pay are outlined on the demand curve, and the most suppliers are willing to supply are outlined, and the minimum they're going to supply it for in price per product or per quantity demanded or quantity supplied is on the supply curve. We're going to put those two together. We're going to bring together the consumers and the producers and have them resolve the market clearing solution. So you put together the two curves for the equilibrium to determine the equilibrium or market clearing result. So these will intersect one minute. So these will intersect at A. I'm trying to make it bigger. The market equilibrium. Let's say we're somewhere else. Why not here? At this price, at this low price, consumers demand, excess demand. What happens is there's some consumers who really want that product more than others, so they're willing to offer a higher price. So some people will fall out of demand, other people will stay, and the price will rise just till $60 and 800 units. Okay? That would be the adjustment to get us to A. That consumers would be willing to offer a higher price, and that would incentivize producers to supply that product. So those two things are happening simultaneously to get us to A. What happens if producers were offering the good at a higher price? Let me erase these marks. What if they were offering the product, producers were offering here at $80 a unit? Whereas we call this we refer to as excess demand. Up here, we experience excess supply. at that price, producers are willing to produce 1,200 units, but consumers only want, at that price, there's only 600 units demanded. So some of the producers fall out of the market. They're not willing to supply it for a lower price. However, the ones that stick around will be able to sell it, again, for a lower price of $60 for 800 total units. $60 per unit. Okay, so there are adjustments in the market at large to get us to the equilibrium that you need to consider. So we say excess supply is when quantity supplied exceeds quantity demanded. That's known as a surplus. Excess demand or shortage exists when quantity demanded exceeds quantity supplied. Assuming the market adjusts quickly to the equilibrium level, surpluses or shortages do not occur in free markets. So it's like an awareness. It's an awareness. It's an information. It's that all the actors in this free, perfect competition marketplace are aware of what people are willing to. Oh, sorry, you can't see that because I enlarged the other one. Let me make this smaller. Sorry. Okay, so those are just the examples I outlined. So these surpluses and shortages don't exist because of perfect information in the free market. And however, if there's an out of equilibrium setting, if it did occur, there was misinformation or asymmetric information. What I described is the adjustment process. So to make this result instantaneous, you need 5 assumptions to hold. Each firm is small relative to market and has no influence on price. Firms and products are substitutable, right? So no one's like particularly loyal to a firm or product. Each consumer is small relative to the market and has no influence on price. Perfect information about prices and quantities is available, and there is easy entry and exit from the market. And entry into and exit from the market, because I was saying, oh, some suppliers will just not offer the product, or some suppliers will be induced to produce. So the assumption, it's a huge assumption that firms can just enter into the market and start producing to meet the demands of the shortage. Okay, I think this is a good place to stop because I'm going to get into consumer surplus, right, and producer surplus, and I can talk about that next week, easy enough. Okay, So I'm going to stop there. Only a few watching anyway. That's right, Nivette. Only in a perfectly competitive marketplace. I mean, you won't get an equilibrium like this. No. So, I will have to I want to do the calculus video as a backgrounder, and I want to do the statistics video for background. That way not everybody who needs that will have to watch it. It's just an optional video, okay? So next time I'm gonna finish chapter 2 and then get into 3 and 4. So in the meantime, I will send you an email of where to see the video for the calculus, the statistics, and yeah, the calculus and statistics. Okay, so good night.